Good morning and welcome everyone to the Money Control live stream. You're watching the opening bell and I'm your host Nickey Mirchandani. Well, historic moment for India, Ram Mandir inauguration in Ayodhya. This brings an end to the 500-year-long exile of Lord Ram, the new idol of Ram Lalla, in its 5-year-old form now. But the good news doesn't really end here. Indian stock markets have surpassed Hong Kong's for the first time, with the total value of the shares listed on Indian exchanges reaching to $4.33 trillion. Well, talk about Indian equity market just for the day. We're looking at a positive start, at least in the holiday truncated week. GIFT Nifty indicates a positive start coming in for the broader index with gains of around 164 points. On to US market, S&P 500 hit a fresh record high overnight on boost from mega cap and blue chip stocks essentially such as Alphabet, Meta Platforms and Apple, which rose between 0.5% and more than 1.1% to be precise. Oil prices edge higher on supply worries due to the war in the Middle East and Ukraine. Talk about Asian equities. Well, they've risen at least in the early deals with focus now on China support and Bank of Japan. Well, Japanese equities look poised for the third straight day of increase, while those in South Korea and Australia also climbed. FIIs, well, the trading on Saturday wasn't really something that we were expecting a big response or volume for, but they continue to be the net sellers for fourth consecutive day, offloaded equities to an extent of 545 odd crore. DIIs, they've offloaded equities to an extent of around 719 odd crore. And earnings essentially that we'd like to watch out for the day is Axis Bank, Indus Towers, GSW Energy, L&T Finance Holdings, Karnataka Bank, Havells India, Mahanagar Gas, REC, Tata Elxsi, United Spirits, Cyient DLM, Glenmark Life Sciences, ICRA are some of the companies which will be in focus ahead of the December quarter earnings on Jan 23rd. But let's get going with the strategies, level and the top recommendation of the day with Prashant from Catalyst Wealth. Prashant, 30 seconds quickly on the Nifty level before we ring the open, we address the opening bell.
Yeah, morning Nickey and morning to all the viewers. So quick note on Nifty, we closed somewhere around 21,570 on the Saturday. So there's a big gap, a resistance between 22,000 to 21,650. I think we are heading towards closing that gap. My suggestion would be the day you see 21,950, 21,970, it would be apt to book profits on the index rather than waiting for a new high. So just take care of that gap, which is around 22,000 resistance. And as soon as you see 21,900, 950, start trailing the index closely and try to book out your positions on the index.
All right, we're just going to be looking at the markets open in just a jiffy. Well, we are looking at some amount of gains coming in. That's what the expectations are. 21,720. That's the mark that we're looking at. And look at the gains. 0.75% of gains clocked in on Nifty 50. That's the one that we need to talk about enough and more, of course. And talk about Bank Nifty. That's the one that we're looking at closely. ICICI Bank, do bear in mind the fact, reported in the numbers. Well, those are the numbers that we'll talk about in more details with Neha Dave in just a bit. But let's address Bank Nifty. Well, almost 0.8% of gains coming around for Bank Nifty index overall. And let's pull up ICICI Bank and RIL, and then we can shift on to top gainers and top losers of the day, because these are essentially two stocks which there will be a close monitoring around. ICICI Bank, of course, has opened in with some vigor out there in early deals. And if you talk about RIL, because the results, of course, came in on Friday, but look at the reaction today. Do bear in mind, Saturday also was a trading session, but it was a trading session marked by low volumes. No DIIs, no major FIIs. So the real reaction actually comes in today, which is RIL is trading in with gains. Talk about the top gainers and the top losers of the day. Well, it is a good day. It's a historic moment that India captured in yesterday, and the stock markets are pretty much participating. Cipla, ICICI Bank and Apollo Hospitals. Well, these are some of the top gainers that we have. NTPC, Bharti Airtel and Power Grid Corporation of India. These are some of the other names that are featuring onto the top gainers list. Top losers, let's pull that up just to see where essentially we are looking at some amount of traction which has been lost out, or the steam which is, Bajaj Auto, Asian Paints, HDFC Bank. Look at the dichotomy between HDFC Bank and ICICI Bank. ICICI Bank is the top gainer and HDFC Bank is one of the top losers. So see this sharp trend that is playing out for the banking sector. This is something that we need to talk about. Well, essentially, we're going to go back to Prashant. Prashant, your view both on HDFC Bank and ICICI Bank and Bank Nifty, now that they're trading at complete dichotomy.
So, Nickey, first I'll start with Bank Nifty. We are quoting around 46,420 and a major hurdle. If you look at the daily chart, there's a resistance between 48,000 and 46,500. So, we are almost on the first level of that resistance, which is 46,500. I'm expecting the move to continue to somewhere around 46,800, 47,000, which would be the levels to look out for the move to strengthen. We need to close above 46,800, 47,000. And for that, a main contribution has to come from HDFC Bank, which has the major weightage in Bank Nifty. As far as ICICI Bank is concerned, the opening is very strong. And if we manage to close around this level, where we are quoting currently, say 1,045, 1,050, that would be a big statement in itself in terms of price. And we can start looking at the next levels around 1,080, 1,085. I think for HDFC Bank, it has been extremely sluggish. It has been making new lows continuously. And now, as long as it doesn't close above 1,500, I think I would not be a buyer in this. I would not try to catch this falling knife. I would wait for a close above 1,500, which is hardly 2.5% from the current price. So I'll buy with insurance above 1,500 and then look for a pullback trade to somewhere around 1,550, 1,570. So that would be my view on HDFC Bank. But I think ICICI definitely looks good.
Well, the street is almost saying that ICICI Bank is the new HDFC Bank, but the size and the scale is something that we need to look on to. Prashant, the top recommendation for the day before we move on to our conversation with Neha.
So I think two stocks, Nickey, and one I would recommend strongly as a portfolio pick. It would be RCF for the next 3-4 months, quoting around 180, 185 with the stop loss spot closing 165. Look at targets around 250, but I'm looking at higher levels from this stock. So currently 250 target and 165 stop loss. Next would be SJVN. I'm looking at a stop loss around 100, 102 and targets around 125, 130 odd levels.
All right, Prashant, those are the two recommendations coming in from Prashant. RCF and SJVN, essentially, this can be looked at for a little longer term perspective, at least when it comes to RCF. But Prashant, we are going to leave it at that. And thank you so much for taking on the time and having this conversation with us. All right, I'd want to discuss more about the banking sector, the dichotomy in trend that is playing out essentially for HDFC Bank versus ICICI Bank. How different are the results of these two banks and what's really inside, or let's just say what's in store more for banking sector in this quarter, or the quarter gone by rather. And to take the discussion forward, we're being joined by Neha Dave, who is the analyst at Money Control Pro. Neha, good morning.
Good morning, Nickey. Thanks for having me.
Pleasure is all ours. Give us a clear, detailed analysis as to what do you draw out of trend from HDFC Bank versus ICICI Bank. How different were the numbers? ICICI Bank, sure, there was some amount of traction which is witnessed in early deals, and we're seeing more losses coming in for HDFC Bank right after the earnings and the FII sell-offs that we've seen. But what's in it with numbers?
Yeah, so clearly, while HDFC Bank disappointed on a couple of parameters in its Q3 earnings, ICICI Bank showed an all-round performance in the last quarter. And if we see the longer period also, ICICI Bank has seen a significant improvement in its operating and financial parameters over the last last 3 years, while HDFC Bank has significantly underperformed the Bank Nifty and the peer group. And this was primarily, this was triggered earlier by the change in the leadership when Mr. Aditya Puri actually had to depart, and then it was followed by the merger announcement. So there has been a long underperformance by HDFC Bank of over 3 years, while ICICI Bank has done well in terms of the stock performance. Now, if we have to compare the actual performance in terms of earnings parameters, ICICI Bank has obviously surpassed HDFC Bank on most parameters. It has not only matched ICICI Bank has not only matched HDFC in terms of loan growth or funding profile, asset quality, capital position, But the most important parameter is that in terms of margins, it is now far ahead of HDFC Bank, and also in terms of the contingent provision that it carries on its books. The numbers look far better for ICICI Bank. Now, if I have to talk just about margins, which was something which the street didn't like in HDFC's numbers, was HDFC reported margins of around 3.4% in the last quarter, while ICICI margins was around 4.4%, and management is confident of maintaining the margins at around 4.5% level for the whole year. Now, there is a significant compression for margin compression for HDFC Bank, while ICICI clearly stands out. So this is one area, a core strength which ICICI is showing. And in terms of loan growth, both banks almost did a similar loan growth. Deposit growth was better for ICICI Bank in this quarter, as it was in line with advances. Another area where ICICI Bank clearly stands out is in terms of contingent provisions it carries on its books. It is around 1.1% of its total loan book. Now, this is very important because this contingent provision acts as a buffer, and it supports the future earnings of the bank. While in case of HDFC Bank, it is only 0.6% of its loan book. So overall, the performance obviously ICICI was much better. One area of concern for ICICI Bank, which I would like to point out, is the robust growth that it has been showing in unsecured lending, that is personal loans and credit cards. This quarter, it grew by around 38%, and now the unsecured lending comprises around 14% of the total loan book. Now, this is something the street needs to watch closely in case of ICICI Bank.
Sure, Neha, I'm just adding a little bit to it. There's a couple of report, actually foreign brokerage report, but actually came up with a report saying the feedback of the clients after the fall that you've seen with HDFC Bank. Not sure if it was CLSA, but there apparently the bull to bear trend for HDFC Bank, well, FIIs at least aren't really that bullish, aren't really that bearish, beg your pardon. But there is more amount of perhaps bearish or somber mood which is coming out from the retail category, or the DIIs rather, for HDFC Bank, due to, the NIMs that you pointed out. And also there is some amount of expectation that as and when the synergies of merger play out, HDFC Bank will be a bigger beneficiary, of course. But do you think that's more time for that to eventually reflect on the books and the margins to percolate back?
Yeah, so see, if we see at HDFC Bank's performance, as I mentioned, that it has underperformed for past 3 years now, and hence it is trading at a lower band, the bottom end of its valuation band. And if I have to talk about the improvement, what will drive the improvement from here onwards? Obviously, we all know that merger has dragged down the financial performance of the bank. But margins, the margins can improve gradually as the bank replaces erstwhile HDFC's market borrowings with the relatively lower cost bank deposits. Also, cost to income ratio can improve over the long term and can offset the increased regulatory drag. So, there obviously the performance can improve from here onwards, but it will be very gradual and it will be only in medium to long term. In the near term, the margins will continue to remain below the pre-merger level of 4.1% for HDFC Bank. Having said that, if we look at the overall profitability of the bank, despite all this sharp fall in margins and merger-related hiccups, it managed to report ROA of 2% and ROE of around 16% in the latest quarter, which per se is a reasonably healthy number. And if you compare it with the current valuation of the bank, obviously it makes the valuation is kind of throws one of its kind of an opportunity to accumulate this stock for the long term.
Yeah, Mia, I think that was a brilliant perspective that you've provided us, that HDFC Bank has been underperforming ICICI Bank for 3 years now, and it's a beat coming in from ICICI Bank on all the parameters. But with this, I think we'll just end it here, and thank you so much for taking out the time and having this conversation with us.
Thank you.
All right, now actually let's navigate our conversation more on the broader issues which essentially need to be addressed. And Prateek Agarwal, who's the Executive Director, Motilal Oswal AMC, now joins us to take the discussion forward more on the fundamental side of the story. Prateek, good morning.
Good morning. Sorry, it was on mute.
No worries. You haven't really missed much. I'm just going to start off the day by saying that, do you know that now Indian markets are now the fourth largest in terms of stock market when it comes to, the Bloomberg data that we're looking at. So any surprises there in terms of the momentum that we're looking at? What do you expect in times of, we've had an historic moment, of course. We also have the interim budget coming up in a few days. What do you think the momentum would look like? And what levels can one look at, essentially?
No, so I think on valuations, on the large cap side, we are at sustainable levels. And the thought is that going forward, markets could compound at earnings growth numbers. The way 26 numbers would shape up over 25 is what we are looking at. So today the earnings growth expectations are in the range of, let's say, 12 to 15%, and index-based compounding should be expected to be more or less in line.
Sure. Prateek, I'd want to chat about Zee Entertainment. That's clearly the stock which needs to be brought up on screen and spoken about. Zee Entertainment Enterprises is the one where Sony Group has terminated $10 billion merger deal. The group has terminated the agreement to merge Zee Limited and Culver Max Entertainment, that is CME, and Sony seeks a termination fee of $90 million on account of alleged breaches by Zee Limited. Of course, CLSA has downgraded this, counter post the fall off of the deal. It's cut also the target price by 34%. What's your assessment out of this?
No, I would not really like to comment stock specific. That is not something that is best done by the brokers. But on the sector, I would say this is a sector which is seeing a lot of changes. If we say theaters, my sense is while last year was a record year, the kind of movies that people really want to go and see in the theater experience is changing. COVID has had some impact there. Similarly, on the home entertainment front, if earlier people were subscribing to cables and viewing channels through there, now it is the time for OTT. So, a lot of changes. I think the space should be given time to settle. At this juncture, it can be a bit speculative.
Sure. Which are the themes essentially? We discussed enough and more about banks. Essentially, Neha and I were having a broad conversation around ICICI Bank versus HDFC Bank debate because they're completely trading a dichotomy. And of course, Zee Entertainment was also something that we brought up. But let's talk about IT with you because that's also a sector which is doing well apparently now. And there are a couple of numbers which have come out by now, or at least all the majors have reported in their numbers. What's your assessment on something like the mid-cap category and versus the big boys within the IT sector? What do you like the most?
So it is more a question of what style of investing one follows. The larger cap IT companies should be expected to deliver earnings growth in the vicinity of 10%. When it gets buoyant, maybe 1 or 2% more. When it gets pessimistic, maybe 1% or 2% lesser, which is going to be lesser than the index earnings growth. So here the whole thought is if something is available to you at discount to value, and you follow that style of investing, this is a place to look at. Quality wise, this is one of the highest quality spaces in the market, no issues. But growth wise, typically speaking, as we go forward, it will lag index growth. Mid cap IT is a different animal. Mid cap IT, the current names that one is focused on are names which are tailwinded in the verticals that they are present in. So it could be autos, for example. It could be R&D, for example. There are spaces which are tailwinded, and their growth in earnings would be an order higher than larger caps. So for growth investor like ourselves, this is the space to focus on. But that said, here again, valuations are definitely catching up. So this then becomes the growth play. From here on, year on year, what you expect is earnings growth or slightly lesser than that, given where the valuations are.
Sure, I'm sure that from an AMC perspective, shorter term duration is not really something that you look at typically. But just taking an aerial view there and perhaps not talking about stocks, but just this theme, and probably for the near term, what are the themes you think one can look at in the run up to the interim budget? Do you expect some amount of momentum catching up for something like a defense, railway? PSU stocks also, valuations have shot up the roof. Though the rally has come through, the valuations, it's difficult to justify the kind of valuation that they're sitting at. What's your assessment?
For value investors, I think while value is still available in some small pockets, it is increasingly getting scarce, is our sense. But we are, like I said before, quality growth investors, so best left to the value guys. Now, in terms of spaces that we believe could continue to work, and they have been working, are new tech. This is a space where I think earnings are coming up ahead of expectation. It's a very fast growth space. So I think this is a space that should continue to outperform. In healthcare, I think there are things which are happening. Even on the medicine side, we are getting positive news flow there. US as a market may be shaping up a tad better than before. In that space, the healthcare infrastructure, hospitals, diagnostics, etc., is where we see continued momentum. The third space where we are really clued on is luxury consumption, and that will include jewelers, that will include premium autos, it will include premium housing, and so on. So, because of let's say the wealth effect on better gold prices, better real estate prices, and buoyant equity markets, I think this is a space where consumption is holding up much better. So this is basically spaces that we are focused on. Yes, capex is something where performance can continue. But here, some of the leading companies are now trading at higher valuations. The theme continues to have a lot of traction. So one sense is that maybe the next rung of companies may end up doing significantly better. Last but not the least, in the BFSI space, we are very clued on to the capital market companies. Now, while banks are struggling in some sense, capital market companies are tailwinded. They are seeing strong action. So exchanges, for example, brokers, for example, the whole RTA kind of ecosystem, AMCs, I think after a long while are seeing positive traction. Valuations in many cases here are very justifiable, given that these are spaces which can deliver very high ROEs. And when there is tailwinds, the growth quotient can also be very high.
All right, Prateek, we're just going to leave it at that. And thank you so much for taking out the time and having this conversation with us.
Thanks.
All right, now let's bring our focus back to Zee Entertainment. That is the one that you need to look at. It's a 10% lower circuit limit that we're looking at for this stock. Of course, it is the stock of the day, and the highlight has been Zee Entertainment. But there are a couple of things I would like to bring on to perspective. A, the revenue and the profitability of the company, if you see for the last 2 years, has been rather subdued. Elara Securities has come up with almost most of the brokerages have got the sell rating on. CLSA has just changed tides to, further downgraded to sell. But most of them, Nuvama, IIFL, or for that matter, even Elara, they all have sell rating on Zee Entertainment. Elara typically says that Zee will see a sharp derating of PE valuation multiples towards at least 10 times 1 year forward value due to the merger potentially being called off, which is the case right now. Due to linear TV growth has converged sharply. Zee may not be able to potentially scale up to that OTT offering in highly fragmented market. That's the second one. Third one, there has been a lower profitability. EBITDA margin ex the sports division losses could converge towards 14%. Fourth, there is a chance of further write-off or matters pertaining to related parties, creditors, or not honoring the sports contract with Disney. That's another one. So there is a bit of combination and permeation which still brokerages are highlighting for the deal perhaps to go through. But that is a long drawn battle. At this point of time, it doesn't really look a very favorable end to the situation that was planned out for a while. So clearly taking it to the chin, and we're looking at some major amount of losses coming in for Zee Entertainment, which is right now locked in lower circuit limit of 10%. So that's the one that we need to talk about. Of course, the Tata Motors, there is a price hike which has happened in terms of for the effective Feb month, beg your pardon. That's going to be the price range by an average 0.7%, which is going to be effective, and its price increases to partially offset the rise in input cost. We're seeing some amount of traction. But what I would also want to talk about is Medi Assist Healthcare Services. Now, this is going to be listing in just a bit, and the final issue price has been set at around 418 per share for this one. Now, do bear in mind the fact that Medi Assist Healthcare stock may actually, at least the expectations are that it might list at a 5 to 12% kind of premium over the issue price on Jan 23rd, which is today. The offer received a strong response from investors, and now the stock is expected to open somewhere between 440 to 470 as per the analyst community expectation. The issue price, of course, this is because of the marquee names in the list of anchor investor list, dominance in TPA, that is third party administrator market, and the decent financial performance. We've also spoken about ICICI Bank and how it's actually done well and is one of the top gainer of the day. Of course, that's all that we have typically in this edition of Trade. With this, it's a wrap, and goodbye from the entire team who puts this piece together. Thank you so much for watching, and please do post your feedback for us in the comment section below. Follow us on the link at the bottom of your screen, and for rest of the updates, stay tuned into moneycontrol.com and Money Control app.